What is happening, investors? It is your boy Jack. I am not a financial advisor, and today we have a tasty little video. We're going to be speaking about 10 of my favorite stocks from 10 completely different sectors. I mean, I'm speaking communications, I'm speaking consumer staples, energy, financial, information technology, real estate. If you can think of a sector, I'm going to speak about it today. The market's in a crazy place, and we're finally starting to see some real positive news emerge. You know, the market is actually somewhat kind of making sense. US jobless reports come out and they look absolutely fantastic in comparison to what we were expecting. And it's important to keep in mind that the stock market is a reflection of what we expect to happen going forwards. So when things started going back up in the market, and the way things are continuing to go back up in the market, that's because we expect the overall economy to start going up. And we are starting to see glimmers of hope all over the place. So what I want to do today is put 10 different stocks from 10 completely different sectors onto your radar, so there's something for everyone. I'm excited for this one. I love putting some new stocks onto your guys' radar. Quickly guys, I have to say, oh my goodness, the growth lately has been immense. On Monday, we hit 5,000 subscribers, and that in itself was absolutely insane. And it's looking like we're going to break 6,000 today, not even a week later. It's crazy. 4 of the last 5 videos are pretty much over 400 likes. The support is disgustingly great. I appreciate you all so much. With that being said, let's see if we can hit 400 likes on this video. Please smash that like button if you enjoy the video. It means an awful lot to me. It really helps me out. Drop me a comment down below. Let me know what your absolute favorite stocks in the world are right now. It doesn't matter what sector they're from, what industry, if they're a growth stock or a dividend. I'm interested in hearing, and I know a lot of people in the comment section will be as well. And of course, people, if you're not subscribed yet, please hit that red button and join the family. The goal is 10,000 by the end of July, and at this rate, we're going to smash that goal. So I appreciate you all so much. Thank you all for being along on this journey. And with all of that being said, let's get into the very first pick of today. We're going to be doing things in alphabetical order, and the first sector we're speaking about today is all communications. Now this one was a very tough one for me. Okay, I narrowed it down to 3. It was between Facebook, Google, and AT&T. Facebook and Google I see as growth stocks, and then AT&T I see as a dividend stock. They have that 6.35% dividend yield, and that is with a 36 plus year dividend growth streak. But if you follow the channel for any period of time, you know that Facebook is literally one of my all-time favorite companies, so it just about takes the edge here. They're the second biggest position currently in my portfolio. So I'm sorry Google, I'm sorry AT&T, you guys have to go for now. So Facebook, one of the FANG stocks, and my favorite of the FANG stocks. I have a full video speaking about these guys, so if you want a 15-minute video that is just about Facebook, I'll have that up in the corner right now. But we're looking at them, okay? Let's just have a look at their 6-month chart, and we'll see their recent highs. We have actually broken through Facebook's previous all-time highs. Since going IPO only 8 years ago, Facebook would have returned you over 500% as of right now. That's in 8 years, guys. Absolutely massive growth. And Facebook as a whole itself is still growing, okay? The third quarter of 2008, they had 100 million monthly active users. As of right now, they are at 2.6 billion monthly active users, and that number just keeps going up and up. Who knows where the limit is for Facebook, but I'll tell you it's not 2.6 billion. These guys own Instagram, okay? They purchased Instagram for 1 billion back in 2012, and it's now worth over 100 billion dollars. They own WhatsApp. You all probably have a WhatsApp account, okay? And have you ever thought about how they make money off you on WhatsApp? Simply put, they don't. Not that we know of yet. There's no ads, there's no, premium fees, there's no premium services you can buy. It's not monetized yet. Facebook wants more money. They can monetize WhatsApp at the snap of a fingers. A few little ads even would go a very long way on a 1.5 billion user platform. Their balance sheet is a sight to behold, okay? 69 billion in current assets, of which 60 billion is in cash. That is absolutely beautiful, okay? Total assets 138 billion. Now, current liabilities only at 15 billion, and total liabilities only at 33 billion. I mean, it does not get much better of a balance sheet than that. Facebook to me is an absolute no-brainer and a half. They are constantly growing. They have avenues readily available to make more money. They are sitting on an awful lot of money. If they want to go and buy a company, they can, whether it's for their, technology, for their CEOs, they can buy it for whatever reason they want. And it's for that reason that Facebook is first on today's list. It is my favorite communications sector stock by far. So second up, we have consumer discretionary. Now, in regards to consumer discretionary, again, there was an awful lot of choices that could have gone in here, but I have gone ahead and chosen McDonald's. Again, another company I own, and another company who's doing quite well for me. If we go from the 6-month highs to where we are now, they are down close to 10%. The S&P is down about 5%, so they're still, you know, a little bit behind the S&P 500. We have a look at McDonald's stock chart, okay, the max stock chart. Let's even have a look at the 5-year stock chart. And the growth has been fantastic. From those lows up to the highs in 5 years, over 120%. In the last 5 years, given everything that's happened, still up very close to 110%. We look at the max stock chart and we go back 10 years towards 2010. And up until now, they've returned over 210%. So there's been some absolutely fantastic growth with McDonald's. Now, I'm very practical in the way I like to invest. The most important thing to me is that it's a company that I understand and believe in the long term. Then what I need to see is, you know, the growth, the fundamentals, the balance sheet to match it. And I don't think there's many companies out there that are easier to understand than McDonald's, okay? They sell fast food. I know for a fact you know who they are. You've more than likely ate their food. No matter where you go in the world, you're going to find a McDonald's. Every time I go to the airport, before we check in, before we do anything, me and Soph, my girlfriend, we go to McDonald's, we get some food. When we get off our plane, you know, before we leave, before we get our bus or our taxi to the hotel, there's going to be a McDonald's. You're going to pass one. Then you get to wherever you're going, and along the way you're going to see a McDonald's. When you get to your hotel, there's probably one within 10 minutes. They're absolutely everywhere. Now, balance sheet, okay? Current assets, 7.5 billion. Total cash and short-term investments, 5.4 billion essentially. So, nice one, okay? Total assets are at 50 billion right now. Current liabilities are just shy of 4 billion, so in a great position in the short term, which is fantastic because these guys did have to, you know, close a lot of their stores. They're only after reopening in Ireland, and I'm sure they're following suit in a lot of the other parts of the world. And total liabilities are close to 60 billion. So total liabilities, yeah, they're above their total assets, but at the end of the day, they're going to be fine. They're going to figure it out. They're going to make enough money. A lot of McDonald's money is tied up in its property, okay? Their plant and equipment as well, but their property. Every single place where there is a McDonald's, that is now McDonald's property. They own that property. So it's not only the food, you know, the cheeseburgers, the nuggets, all of that stuff. It's also the real estate that the buildings themselves are built on. And they also have a 2.5% dividend. And I know that's not the biggest dividend in the whole wide world, but keep in mind that in the last 5 years, they've returned over 100%. The last 10 years, over 200%. And on top of that, they're paying that dividend. When you look at it that way, it's a tasty little dividend. It's a tasty little bonus. It's just so simple to understand these guys. A 5-year-old could tell you what these guys do. And it's for that reason they have made the list. They were one of the first companies I bought, and I'm very happy to hold them. Okay, so moving on from consumer discretionary, we go on to consumer staples. Oh guys, this was a really tough one. I shortlisted it down to 3. The first one we're having a look at is Sysco, okay? The largest global distributor of food. Next up we have Pepsi. If you're a long-term follower of the channel, you know just how much I love these guys as a relatively safe defensive investment. And then thirdly we have Altria. So another company I've made a full video on that I absolutely love. They have a dividend yield of over 8% that they have increased for over 50 plus years. They're getting into so many emerging markets. Again, for a full video on these guys, I'll leave that in the corner. If I could only invest in one, I have to be completely honest with you, thinking about it from a very long-term point of view, I think first I'd have to get rid of Altria. Although right now, they're probably my favourite one to buy. Genuinely, my favourite one to buy right now would be Altria. But from a super long-term point of view, I think they have to go. They're just a little bit of a higher risk. They've performed quite poorly the last few years. Now, I do believe that they're going to perform very well going forwards. But for the sake of this video, we will eliminate Altria. But if you were looking for a really nice dividend company, please do look into Altria. Now, this is where things get super difficult, okay? Pepsi has about a 3% dividend yield. You know, Sysco is very close there as well. They both have very similar PE ratios. Sysco sitting at 23.31, Pepsi at 25.68. Pepsi has a dividend growth streak of 47 plus years. Sysco has a dividend growth streak of 51 plus years. There is not that much divide in these two companies. If we look at both of their performances right after the Great Recession, okay? Sysco, from lows up to their highs, went up over 300% and are currently up over 200%. Pepsi, from lows up until highs, they went up about 200% and are currently up about 172%. It's so difficult, okay? And I'm surprised I'm saying this, but if I could only choose one, I would have to choose Sysco. I would see Pepsi, honestly, as the more defensive investment. I would expect to make about 10% or so a year from Pepsi, and also they have that dividend. But for now, Pepsi, you are gone. Fact of the matter is, guys, I just absolutely love Sysco, okay? The largest global distributor of food. Everybody is always going to need food. These guys obviously fell on tough times because of the virus, okay? Most of their customers, 62% of their sales come from restaurants, and you're all fully aware that every single restaurant in the world had to shut down, and now they're beginning to open back up. These guys are still down 25% from their recent highs. I just see a lot more short-term growth potential from Sysco. I think getting into Sysco at this price is a little bit better than getting into Pepsi at their current price. Again, Sysco, Pepsi, Altria. I love all three of them. I own all three of them. If I could only choose one to buy right now, Sysco takes the biscuit. That was a tough one. Let me know what one you would have chosen in the comment section down below. Okay, next up we have energy related stocks, and again, this was a tough one for me. I did ultimately come to the decision though that Exxon Mobil is my favorite company in the energy sector right now. And I didn't even know this until right now, but these actually are the third biggest position in my portfolio after Delta Airlines and after Facebook. So these guys, from recent highs to where we are now, again, a company who's still down 25%. What I will say is that pre-crash, they were a company who was already struggling. You know, they were trading very sideways. But this could be what they need. You know, this crash could be offering us a really good price point to get into them. Even if they can start to approach those previous highs of $80 to $90, you know, we're looking at anywhere from a 60 to 70% return in the relatively short term. And then if Exxon can just completely and utterly get back on their feet and get back to doing some real growing, this is going to be a fantastic price point. And what's very important to keep in mind is they have a 6.5% dividend yield. So for you dividend investors, that's juicy. And what's even better, yet again, is we're looking at a company with a 37+ year dividend streak. So a very nice history of paying those dividends. And they've been increasing that dividend at a nice rate. What's important to keep in mind with all energy related stocks, all oil related stocks, whatever it is that economies are beginning to open back up. The US unemployment rate declines to 13.3% as economy restores 2.5 million jobs in May. Analysts were predicting this to go as high as 20%, and already we're seeing a recovery. We're seeing more jobs being created. Do you know what more jobs being created means? It means that the demand for oil is going to go up. So that is obviously very nice for us investors. And aside from that, full countries, full economies are starting to open back up. Airlines are doing 3 times more flights than they were only 2 months ago. Lots and lots of countries are opening up to international travel within the next month or so. More people driving to work, more people flying across the world. A lot more oil is going to be needed, and the likes of Exxon are going to benefit. But yeah, they were my favorite energy company just because I do see a lot of upside potential, and they have that very nice dividend. And if you know me, I love investing in companies with very high dividends and high upside potential. Okay, number 5, we're going over to the financial sector. Okay, ooh, the financial sector. They have all been hit very hard right now. So here I have 2 bank stocks to show you. The first one is Wells Fargo, and this is the one I'm going to spend the most time on. And the second one is JP Morgan. So to me, Wells Fargo is my personal favorite, but that's because I'm willing to take a bit of a risk on them, okay? I think Wells Fargo are the higher risk, higher reward company of the two. I think if you want to get into a bank stock, but don't want a very high risk, high reward play, JPM is your play. Reason being, okay, Wells Fargo from the recent highs fell as low as negative close to 60% and is still down over 40%. JP Morgan fell as low as 42%, and are now only down not even 20%. Like I just said, I love companies who I see having an awful lot of upside potential and a big dividend. Wells Fargo has that 6.44% dividend. Now, what I will say is that is only a dividend streak of 9 years. In the past, when times have got tough, they've had to cut this dividend massively. And what I will say further is that I'm not completely confident this dividend is going to stay at 6.44% or even any sort of a respectable dividend. Nobody knows, but I'm not the most confident in the world. But what I will say is when times get tough economically, these bank stocks get hit horrifically. Again, let's go back to the Great Recession. Once these guys started to recover, okay, let's just see where we would have gotten. At one stage, look, they would have given you over 650% in less than 10 years. As of right now, you would still be up 267% if you got in at the bottom. And that is after this 50+% drop. To me as well, a bank stock is just a long-term bet on America doing well. That's what it is to me. And I believe in America, and I believe in America doing well. So what I want to do is I want to take the high risk play, you know. I could lose some money, I could be in the red for a very long time, or I could make a lot of money. See, to me, JPM is a relatively safe investment. I don't want a relatively safe investment in the financial sector because I see the financial sector as one that can provide an awful lot of growth if you get in at the right price. If I want a relatively safe defensive investment, I'm just going to go, you know, to my dividend stocks, to my consumer staples, healthcare, those kind of places. Now, I do own a position in JPM, and to an extent, that is just to hedge my bet on WFC. If something really bad happens in the short term, Wells Fargo will get hit very hard. JPM more than likely will as well, but not quite as hard. So what I can do is, you know, I can either ride them both out, I can ride out the storms, or I can decide, you know what, I've made a mistake, I can just sell both off at whatever loss I've made, and I've already decided that I'm willing to take that risk. So bye bye JPM, Wells Fargo is my choice, and I don't expect a lot of you guys to agree with me. I know I get people arguing with me about Wells Fargo in the comments every single video. That's fine. I completely understand your point of view. Please just try and understand mine. I understand it's a high risk stock. I'm 22 years old, man. I can afford to take some risk, you know. I'm not going to go bankrupt. Okay, next up we have the healthcare sector. And this one was probably the easiest one for me to decide. It's Johnson & Johnson, okay? A very safe, very defensive, low dividend paying company that more than likely you're not going to lose much money on pretty much ever. Looking at the 6-month chart, these guys dropped down about 27% from highs to lows. They came up and made new highs briefly, and right now they're down less than 5%. So outperforming the S&P, they're in a fine position, and they do indeed have that 2.74% dividend yield with a 99 dividend safety and a 57 plus share uninterrupted dividend streak, and they're growing that dividend quickly. So it's at 2.74% now, but someday that could be a 3.5-4% dividend in one of what is deemed to be the safest companies in the world. So to me, J&J is just a defensive bet, okay? I don't expect any massive growth, I don't expect any massive dividends, I don't expect much from them, but I still want to hold them in my portfolio. They don't take up a very large portion, they are what they are. A lot of people will speak about AbbVie, Pfizer and Gilead Sciences as having more upside potential and better dividend yields, and I would agree, you know, I genuinely would agree, but to me, the healthcare sector is not really where I'm going for my growth stocks. It's not where I see the most potential, so I would rather just play around with my defensive investments in this particular sector. Okay, next up we have the industrial sector. We're having a look at Caterpillar Inc. Again, a lot of you guys probably are on this, guys, or do have these guys on your radar, and I very much so like the look of them. So we'll just start off from highs down to lows, down about close to 40%, and as of right now, only down 10%. So it's been a very nice recovery. They're not too far behind the S&P 500, and they're in a relatively struggling industry, so they've done quite well in my opinion. These guys have a dividend yield of 3.05%, a dividend safety of 93, and an uninterrupted dividend streak of 27 plus years, making them a dividend aristocrat. And they have been growing that dividend very quickly. Last year, an 18% growth. The last 5 years, 8%. The last 20 years, 10%. So these are definitely a company where you can expect, you know, relatively soon to be paying us a 3.5 to 4% dividend within a few years, 5 years. So these guys do have their foot in a few different industries, okay? Energy and transportation is 38% of their profit. Serves oil and gas, power generation, industrial and transportation markets. Then construction industries, 38% tied to infrastructure spending. And then the resource industries, mining and heavy construction and financial products, they provide financing for Caterpillar equipment. So they're the world's largest construction equipment manufacturer. Easy to understand why they would have fallen on tough times. You know, when a lot of these construction companies fall on tough times, they're not going to be buying new equipment, but when things get good again, which will happen when economies start opening back up, countries start opening back up, oil production is back up, these guys will see the benefit. And so that's starting to get priced in now. We can see we've had some very, very nice growth the last month because there's a lot more optimism in the market. So I do see these guys having a considerable amount of upside potential. Now, I don't see them as a growth stock. I don't think they're going to give me hundreds and hundreds of percents back in a matter of a few years. You know, they're not a Facebook, they're nothing like that. But again, I like being diversified and I like these guys. Not the kind of company I'd put too much money in or have too much of my portfolio riding on, but a company I'm happy to own nonetheless. Okay, next up we have information technology. And again, this was a relatively tough one for me. Okay, so Apple makes the list. Okay, another FANG stock, another company I absolutely love and I want to be a very big portion of my portfolio. Then we have Microsoft stock. Again, another one I absolutely love, who I think has so much upside potential, so much growth potential. And then lastly, one that not as many people will probably be interested in, we're looking at Sysco Systems. So just quickly, in case you don't know what Sysco Systems do, okay? They're a company in communications equipment. They have a 3% dividend yield, a 91 dividend safety score, and where are we? Only a 9-year uninterrupted dividend streak. So they sell a wide variety of products and services to businesses of all sizes. Their main offerings connect computing devices to networks, or computer networks with each other, aka, where are we? Switches and routers. Switches are used in buildings, offices and data centers to connect devices such as workstations, servers and phones together on a computer network. And then routers pass along data packets between computer networks to connect wireline and mobile networks used for mobile, data, voice and video applications. So again, a company I do own and a company I'm up in, but they're the first one I'm going to tick off today. Now things get really difficult. It's between Apple and Microsoft. Two companies I absolutely love to pieces. Two companies I want to take up decent portions of my portfolio. It's a very difficult choice. If I could only buy one by Microsoft, it's going to be Apple. We're going to start it off with their absolutely monstrous balance sheet, okay? Cash, 94 billion, okay? Current assets, 143 billion. Total assets over 320 billion. Okay, we go to current liabilities 96 billion, and we go to total liabilities 241 billion. So an absolutely fantastic balance sheet. They're in a fantastic position going forwards. From the recent highs to the lows, these guys dropped 31%, and they have gone ahead and made new highs. 5-year chart up 160%, 10 years up 788%, 15 years up 6500%. Massive growth stock. Easy to understand company. Okay, you probably use some of their products. I'm recording on a Mac right now. I have my iPhone right here. I absolutely love their products to pieces. They've had immense growth. They're trading at a PE ratio of 25.99, which traditionally is high, but for a FANG stock, that is low. They have an amazing balance sheet. Their fundamentals are in place. They're incredibly easy to understand. Absolutely love these guys. That's why they get the choice. Okay, real estate, the second last sector. We're having a look at a company called Realty Income Corp, and these guys are an REIT, a real estate investment trust. A dividend yield of 4.5% and a 25 plus year dividend streak. You won't find many REITs with a 25-year dividend streak. Now, these guys have bet a lot of rates on how much money they've made during these tough times. Back on May 6th, they released earnings and reported that 83% of rent was collected in April, which, given the circumstances, was very good. It was better than expected. Some of their biggest tenants: Walgreens, 7-Eleven, FedEx, Walmart, Sainsbury's, loads of big companies. Now, in previous videos, I've said that I don't particularly believe in the future of, stores, these big massive places, malls, things along those lines. At the same time, I don't think they're going to disappear off the face of the earth anytime soon, so I'm happy to invest in these guys for now, but I will have to keep a relatively close eye on them, because I don't think it's the kind of company I'm going to be holding for 20-30 years. Balance sheet looks very good. Total assets nearly 18.8 billion, total liabilities only at 8.3 billion, so they're able to get through, they're able to weather the storm right now. 6-month chart, these guys are still down close to 25%, which is something I personally actually like to see right now. Max stock chart, we can just see some very steady growth in the upwards position. So no mental growth, they're definitely not a growth stock. They're not going to pay you back hundreds and hundreds of percent, but they do have that 4.5% dividend yield. I know when it comes to rates, you can oftentimes get 7, 8, 9, 10+% dividend yields. I just think this is one of the much safer options out there. Obviously, if you want that high risk, high reward stock, there are better choices. But for me, I'm relatively happy with these guys at this price point. They've done me well so far. And the final sector we're going to have a look at today is utilities. And it's a company I've spoken about quite recently. We're looking at a company called Consolidated Edison. Again, one that doesn't get spoken about too much, but I personally do like the look of. The only company on today's list that I don't own just yet. I was going to buy them this week, but I decided to take a step back. I didn't buy anything at all this week, just because the market was so good. So I'm looking into next week more than likely picking these guys up. So that 4% dividend yield, which we all love to see, a 90 dividend safety, and a 46+ year dividend streak. Now keep in mind that dividend is being grown very slowly, so it's going to be around 4% for a long time. What these guys do is they serve as a regulated electric and gas utility to the New York metro areas and Westchester County, New York. 88% of their 2018 earnings came from providing electric service to approximately 3.5 million customers and gas service to about 1.1 million customers in New York City and Westchester County. So I mean, it's New York. Everybody needs electricity. There's a lot of people living there. There's more and more people living there. There's more houses, more apartments, a bigger population. These guys definitely have room to grow, in my opinion. On the 6-month chart, still down very close to 20%. On the 5-year chart, up to the highs, they were up 63%. Right now, up 30%. And then again, as we left the Great Recession last time, they went up over 160-ish%, and you'd still be up over 115%. So another one of those companies. I wouldn't necessarily say they're a defensive investment. I do see some nice potential here. And again, if you're a dividend investor, they have that 4% dividend yield, and that's what a lot of people do like to aim for. So it's a very nice dividend company that has proven themselves to give some good return when bought at the right price. So for me, dividends aren't my top priority yet, but I still do want to be adding to them. I don't have a company like this in my portfolio, so to me it makes a bit of sense to get one in there. And that is the 10 stocks for today, guys. Lately, guys, I've just been trying to put more and more stocks from more and more different sectors onto people's radars, as I know a lot of people aren't finding much value in the market. So I hope today I was able to put at least something onto your radar. If you did enjoy the video, please do drop it a like. It genuinely helps me out so much, and the support lately has been absolutely insane. It genuinely means so much to me. Please do subscribe if you're new around here and join the family. Again, we're on the road to 10k. It's so exciting to me. Drop me a comment down below. Let me know your favorite stocks at the moment. What stocks you are keeping an eye on. And I hope you all have an absolutely fantastic day. I will catch you for tomorrow's video. Peace.